we'll talk about why the election results are close to ideal for our type of long-term investing. And then Rakshit will get into CCP, where it stands, why CCP has recovered nicely in the last year or so, and why we think CCP is set for a very nice catch-up where share price compounding catches up with the stellar EPS growth that the investee companies have shown in the post-COVID world. So I'll begin with a slide on why the election results are close to ideal for long-term investors like us. So I'll step back a little bit. If you look at India's GDP growth over the last 20 years, it's not made much difference. Actually, over the last 30 years, it's not made much difference which party is in power, whether it's a coalition government or it's a majority government. The country's done around 6.5% reasonably consistently. And by the way, the same holds true for stock market compounding. But stock market compounding hasn't so much been predicated on is it UPA, is it NDA, is it a majority government, is it a coalition government? The stock market has compounded over 10, 20, and 30 years at such a stellar pace that over the last 3 decades, over the last 2 decades, over the last decade, we've been amongst the world's best markets. In fact, it's United States 1, India 2, or India 1, United States 2. These are the two big markets in the world, and very similar markets. Just like in the United States, it doesn't matter whether the Republicans win or the Democrats win. Neither matters for GDP growth nor for the stock market. Very similarly in India, stock market outcomes, economic growth outcomes have been broadly, resolutely strong, regardless of whether it's a coalition government or it's a majority government or the color of the government. Now, why is this? Why does economic growth and stock market outcomes not hinge as critically on coalition governments or lack thereof in Delhi? Part of the reason is the composition of India's GDP growth. If you take India's state level GDP growth, break it down, what you see is that roughly 60% of India's GDP growth comes from states, comes from regions where the color of the political outcome has very little to do with the economic outcome. So whether it's the NCR region, Gujarat, or Peninsular India, by Peninsular India, I'm referring to Maharashtra, Karnataka, Telangana, Tamil Nadu, Andhra, Kerala. Whether it is Peninsular India, Gujarat, or Delhi, these are the parts of the country where 60% of the growth comes from. There is very little linkage between which political dispensation is in charge of that state and the GDP outcomes in that state, right? And the result of that is you and I are able to get economic outcomes which are reasonably steady, regardless of what the political situation is, either in the state capitals or in New Delhi. Now, add to that, I think what's good about the recent results is the coalition government construct, I think, creates a burning platform. The burning platform, I'm sure for everybody who's listening, the burning platform must be obvious to everybody who's listening. Job creation has been weak for a couple of years. The post-COVID recovery has hurt the lower two quintiles of Indian society. If you want to see how powerful the negative impact of the post-COVID recovery has been on the two lower quintiles of Indian society, read Rama Bijapurkar's fabulous book, recent book on how wealth and income outcomes have got skewed. Wealth and income outcomes have got skewed in favor of people like you and me and against the two lower quintiles of society. With job creation weak, wealth and income creation weak for poorer people, naturally there's been a political blowback for that, and that creates a burning platform, which I'm sure the government that will take charge on 9th will respond to. There is a burning platform. I'm sure there will be policy responses which drive consumption, drive job creation, and remediate the misery that the poorest 40% of India has experienced over the last 3 years, right? There's another reason why I think the election outcomes are good. Typically, India goes through 5 to 6 year cycles. So in a 6 years cycle, the stock market tends to have 2 to 3 years where companies with weak accounting, weak governance tend to have a bull run, right? This is typically happens in a bull market. In a bull market, people say, forget the governance quality, forget whether the promoter is a naughty man or not. Let's just buy because it looks optically cheap. And in a rising tide of a bull market, even low quality companies get dragged up. And that's broadly what's happened in calendar year 22 and 23. Most of the companies with weak accounting scores in our forensic framework have done brilliantly. Unfortunately for you, for those of your Marcellus clients, we don't invest in companies with weak accounting scores. But as I'm sure most of the 424 people listening know, many companies with weak accounting have had seen their share prices triple or quadruple over the last couple of years. I reckon that party is close to ending. I won't be able to tell you which week or which month the party ends for companies with weak accounting, but this sort of political outcomes tends to be a precursor. This sort of political outcomes tends to be a precursor for poor quality accounting stocks having an almighty blow up, right? So I think a good result for those who want to see consumption revived in India. Good result for those who want to see a proactive, energetic government continuing to drive with high energy execution. And if you then come to how our portfolios are placed, because that's the core of the webinar, where is CCP placed? Step back and think about the macro landscape, right? Whilst consumption might be weak, corporate India's debt equity ratio is at a 20-year low. Corporate balance sheets are in superb shape. The banking system is also in superb shape. In fact, the tier one capital of the banking system at 16% is actually not just a 20-year high, it's the highest in the world amongst the big economies in the world, right? 16% tier one means that the banking system is in super shape. Corporate India's balance sheets are in super shape. Therefore, you and I shouldn't be concerned about the economy, right? The economy should not be a concern. And if you look at our type of portfolios, we look at CCP. Rakshit will take you through the stocks, but it's a play on premium consumption. It's a play on healthcare. It's a play on knowledge-intensive exports such as pharma, and it's a play on private capex, right? So this combination of private capex benefiting from corporate India's great balance sheet, premium consumption benefiting from the rising wealth of the people who are on this call, healthcare, natural area of boom as the country goes up the per capita income chain, and knowledge intensive exports, a natural beneficiary of China plus one. This construct is beautifully placed in India. EPS compounding has been stellar, absolutely stellar. F24, F23, F22, year after year, these companies have gunned out superb EPS compounding way ahead of the Nifty. As I'm sure all of you know, share price compounding has lagged. Share price compounding has lagged EPS compounding. The chart on the right-hand side illustrates the same, right? The red line in the chart is the earnings growth of the CCP, stellar, steady progression in earnings. That's why we call it consistent compounders. But the dashed blue line is the market cap. That's where CCP has lagged the Nifty over the last couple of years. Needless to say, this sort of political outcome creates the conditions for a catch-up. Your earnings growth is like this, your share price compounding has been like that, and you get a catch-up. If there was no catch-up, honestly, there would be no need for us. All you'd have to do is look for companies with great EPS growth and buy them. The fact that EPS growth and share prices don't always move in lockstep is why people like us have a job, and elections like the one we've had recently create the ideal conditions for a catch-up. Is there something for you to worry about in this sort of political landscape? I think there are a couple of things you and I need to keep our eyes on. Firstly, we'll have to see what the first budget after the election. This is in July. I think it'll be 12th or 13th July that the first union budget will come up. We'll have to see how the coalition government plays its cards. As I said, there will be obviously enormous political pressure for welfare benefits for the poor. But if they do helicopter drops of cash, we'll be disappointed. If they come up with sensible policies to create jobs, to do Ayushman, a step up in say Ayushman Bharat, a step up in PM Awas, those are the sorts of things which I think will be encouraging for stock market investors like us. So that first budget in July, I think, is critical. The second is the private sector revival. Remember, our portfolio contains private sector capex stocks. Private sector capex has only started reviving in the last 6-7 months. It's a nascent recovery. We'll have to see whether that holds in light of the political outcome. And the third, in a way, linked to the stock market, linked to the election pieces, this got a crazy sign up in retail investors that we have seen. 3 years ago, India had 30 million retail investors. Today, India has 120 million retail investors. Actually, India today has 150 million retail investors. We've gone 30 to 150. So we've added 12 crore. India has added 12 crore retail investors in the last 3 years. Looking at the sort of stocks they're buying, looking at the crazy surge in F&O volumes, it's not clear to us that a lot of this is sustainable. And the question is, when does this incredible retail investor party, right, managing 12 crore people, 120 million people have come on and basically started punting on FNO and on small cap stocks. We don't quite know how this party ends. Our hope is that it doesn't end in a disorderly way with a meltdown. So those are the three areas to be careful about, right? The first, budget. Will the government turn sort of needlessly populist? The private sector capex revival, and the retail investor. How will the retail investor fare now that the road ahead gets a little choppier? We'll keep an eye on those. My reading is CCP is reasonably well insulated from these three risks, and CCP is well placed to benefit from all that is good about our country, which is elite consumption, premium consumption, knowledge intensive exports, the ongoing privatization of health in the country, and finally private capex.